Hello there, Prof. Aram here, and in this video we're going to look at the Modigliani-Miller's setup for their first theorem when they assume zero corporate taxes. So let's get to this. First of all, they consider the capital of the company to be a pie, and each slice of the pie represents how much of total capital is provided by a specific type of capital. Like, for example, they look at the right-hand side of the balance sheet when you have debt and equity, and they look at the left-hand side, which are the assets of the company. So what they're saying is that the assets of the company, which resembles the value of the firm, is fixed. And you can slice this pie, the right-hand side, however you want. That doesn't affect the value of the firm. That doesn't affect the size of this pie. So if you have 40% stocks and 60% bonds, or 60% stocks and 40% bond, that doesn't really matter. The value of the firm is still going to be the same. How you slice this pie or how you pay for the assets of the company doesn't really matter, because the size of the pie remains the same, because the present value of the cash flows of the company remains the same. And this can only happen if the future cash flows are the same. The stream of the cash flows remain the same, meaning that we know one of the assumptions of Modigliani-Miller was that the growth rate of the cash flows is zero. You're going to receive the same cash flow as long as the company exists. And they prove that under these conditions, given their assumptions, remember they had a few very restrictive assumptions, changing the capital structure does not affect the value. They show that it doesn't matter how you slice the pie. In other words, it doesn't matter how you source your capital or how you pay for the assets. The value of the company is going to stay the same. In other words, in a perfect capital market where corporations and investors can borrow and lend at the same rate with risk-free rates, and investments and financing decisions are independent of each other, investors can create their own capital structure. So if I don't like the capital structure of the firm that I'm investing in, then I can create my own leverage. The capital structure chosen by managers doesn't matter, because I can adjust my own capital structure and create my own desired capital structure at no cost, because I can borrow and lend at risk-free rate that is available to corporations. They call this a homemade leverage. Homemade leverage is basically personal borrowing and lending to increase or decrease the leverage respectively. For example, if I'm owning the stock of the company that has no debt, I can personally borrow money and use the proceeds to buy the shares of this all equity company to create my own levered cash flows, levered stock cash flows. So again, in the first case, you are borrowing money and buying this stock with the borrowed funds. Or if the company has too much debt, you can sell the stocks of that company and use the proceeds to lend it to other investors. In this case, you're going to end up with an unlevered stock cash flows. For example, let's say that the company has a capital structure that is 50% debt, 50% equity, but your desired capital structure is 70% debt and 30% equity. The investor uses borrowed money to finance his or her share purchases so that effectively ownership of the company's assets reflect a preferred 70% debt. So I can borrow more money and use the proceeds to buy more shares of the company, to the point that my capital structure, my personal capital structure, is going to be 70% debt and 30% equity. To the extent that this change in capital structure has no effect on the company's expected operating cash flows, the capital structure decision has no impact on the value of the firm, because each person can create their own desired homemade leverage. My homemade leverage might be different from your homemade leverage. And Modigliani-Miller used the concept of arbitrage to demonstrate their points. If the value of the unlevered firm company is not equal to the value of the levered company, then investors can make arbitrage profit. They can sell the overvalued asset and use the proceeds to buy the undervalued asset, which basically, and they make a riskless profit. But this arbitrage opportunity, which investors take advantage of usually, would quickly force the value of the two firms to become equal. In other words, arbitrage opportunities don't exist for a long time. Usually investors take advantage of them and the market will balance to the point that both firms are going to have the same value. So the importance of Modigliani-Miller is that it demonstrates that managers cannot create value simply by changing the capital structure. And it is true because operating earnings of the business are available to the providers of the capital. If you're an unlevered firm, all equity firm, all the operating earnings are going to be available to the shareholders of the firm, which is the present value of these earnings. But if the company is levered, meaning that has a mix of debt and equity in the capital structure, now these operating earnings are split between the shareholders and bondholders. And under these conditions, if we are in an equilibrium, the sum of the value of the debt and equity in that case would be equal to the value of the all equity firm. In other words, the value of the company is determined solely by its cash flows. As you remember, we only care about the cash flows of the company, not how we finance our assets with debt or equity, not by the relative reliance on the debt and equity capital. I hope you find this video useful, and thanks for watching.